This is the Daily Market Comment by Rafi Boyadjian. I'm Maria Pachurdiz. Thanks for joining us at XM.com. U.S. Treasury yields are heading lower for the third day on Thursday, with the 10-year yield slipping below 2.70% as the recent heightened expectations that the Federal Reserve will hike rates very aggressively eased somewhat. A slightly softer than expected increase in the March core CPI print in the U.S. on Tuesday gave rise to hopes that inflation is plateauing, a view that seems to be shared by Fed Governor Christopher Waller. If that assessment turns out to be correct, it could mark a turning point for toward equity markets that have been under pressure all year as central bankers around the world have accelerated their normalization plans to remove pandemic-era stimulus. However, the Fed is only just getting started with its rate hike cycle and is unlikely to let its guard down just yet. The Producer Price Index for final demand jumped by the most on record in March, hitting 11.2% year-on-year, suggesting that inflationary pressures remain as elevated as ever. Nevertheless, investors see light at the end of the inflation tunnel for the first time since the conflict in Ukraine roiled commodity markets, pushing the price of key raw materials higher. Global stocks were mostly in positive territory on Thursday, following strong gains in the U.S. yesterday. The advance on Wall Street came in spite of the wobbly start to the earnings season. In Asia, stocks were lifted by speculation that China will loosen monetary policy again. In the FX spectrum, the U.S. dollar slipped on the back of the decline in Treasury yields. The dollar index has fallen below the 100 level, with even the battered Japanese yen gaining some ground today. The euro has rebounded above the $1.09 level, but where it goes from here will likely depend on what the European Central Bank decides later today. The ECB might announce a more precise timeline of when its asset purchases will be wound down, and even if policymakers refrain from committing to a rate hike timetable, the QE end date would be taken as a strong signal of how soon liftoff will come. The Canadian dollar, meanwhile, has bounced to one-week highs versus the greenback. As expected, the Bank of Canada raised rates by 50 basis points on Wednesday. This is today's Daily Market Comment. Thanks for joining us at XM.com.